Chapter 16, Budget and Fiscal Policy. A public budget is an annual financial statement which is an estimate of expected revenue and anticipated expenditure in fiscal year. The budget reallocate the resources so as to guide the economic growth of a country, whereas fiscal policy is the means by which a government adjusts its spending level and tax rates to monitor and influence nation's economy. Public budget. Public budget is a statement of estimates of the government's expected receipts and government's expected expenditure during the financial year or fiscal year, which starts from 1st April and ends on 31st March. In India, Article 112 of the Constitution requires the central government to prepare annual financial statement for the country as a whole. This is called budget of the central government. Article 202 of the Constitution requires every state government to prepare annual financial statement for the concerned state. This is called budget of the state government. Objectives of public budget: redistribution of income and wealth. Government, through fiscal tools of taxation and transfer payment, brings fair distribution of income. Equitable distribution of income and wealth is a way to bring social justice. For this purpose, progressive tax structure is followed in India, in which burden of tax increases with increase in income. It is also known as distribution function. Reallocation of resources. The government of a country, through its budgetary policy, directs the allocation of resources in a manner such that there is a balance between the goals of profit maximization and social welfare. Example, there should be production of necessity goods as well as comfort and luxury goods. Also, the government should undertake the production of public goods for promoting social welfare. Public and private goods. The goods which cannot be provided through market mechanism and hence must be provided by the government are called public goods. Example, roads, parks, street lights, etc. These goods have two distinct features as that of non-revelers. It means consumption by one individual not reduce the amount available for the others. Non-excludable. It means that once a public good is provided, then no one can be excluded from its consumption. These goods promote social welfare. On the other hand, goods which can be provided through transactions between consumers and producers are termed as private goods. For example, food item, clothes, shoes, etc. These goods are frivolous and excludable in nature. These aim these aim at profit maximization, economic growth. The growth rate of a country depends on the rate of savings and investment. Therefore, the roles that are assigned to budgetary policy in this regard are to create conditions conductive for increase in savings and investment. Generation of employment. Government needs to promote labor intensive technology, public work programs like construction of roads, dams, canals, bridges, etc. to promote employment generation in the economy. Several programs are initiated through budget to reduce the problem of poverty and unemployment. Economic stability. Government tries to establish economic stability by its budgetary policies. Economic stability refers to a situation without fluctuations in price levels and stability of exchange rate in an economy. Economic stability is achieved by protecting the economy from harmful effects of various trade cycles and its phases: boom, recession, depression, and recovery. Management of public enterprises. Public sector enterprises are owned and governed by the government, and through budgetary policy it tries to manage the expenditure and revenue of PSUs. Impacts of budget. Budget impacts an economy at three levels. It brings aggregate fiscal discipline level. Budget tries to maintain an ideal balance between revenues and expenditure of the government. It brings better allocation of resources. Government through its budget will allocate resources to those areas where it is socially desirable. Through budget, government can effectively and efficiently plan and implement its social welfare programs. Types of budget: traditional budget, general budget. A traditional budget indicates the amount of money allotted during a set time period for specific financial obligations. This budget was developed in the 18th and the 19th century. In this form of budget, the government allocates its anticipated income for meeting anticipated expenditure. In this form of budget, components are more important than objectives. Important documents of Indian government related to Central Budget of India, Speech of Finance Minister, Statement of Annual Finances, Summary of Budget, Finance Bill, Budget Receipts, Budget Expenditure, Demand for Subsidies. Outcome Budget. An outcome budget measures the development outcomes of all government programs. For instance, it will tell a citizen if money has been allocated for building a primary health centers has it indeed come up. In other words, it is a means to develop a linkage between the means spent by a government and the results which follow. Outcome budget has the following characteristics: make budget cost effective, aid better scheme management, improving program effectiveness, communicating programs goals. It is transparent budgeting system. It is result oriented, correlates the fiscal and financial aspects of programs and activities, improves budget formulation, review and decision making at all levels of management in the government machinery, facilitates better appreciation and review by the legislature, makes possible more effective performance, measures progress towards long-term objectives and envisaged in the plan, brings annual budget and developmental plans together through a common language. First outcome budget in India. Outcome budgeting in India was introduced by the former Finance Minister P. Chidambaram from Budget 2005 to 6 on 25th August 2005. It is based on the idea that financial outlays in the budget do not necessarily lead to outcomes. We, the people of the country, are concerned with the outcomes. Zero waste budget. It is a method of budgeting is that in which all expenses must be justified for each new period. Zero waste budgeting ZVB starts from a zero waste, and every function within an organization is analyzed for its needs and cost. Budgets are then built around what is needed for the upcoming period, regardless and whether the budget is higher or lower than the previous one. ZVB allows top level strategic goals to be implemented into the budgeting process by tying them to specific functional areas of the organization where cost can be first grouped, then measured against previous results and current expectations. Zero waste budget has the following characteristics. Manager of a decision unit has to completely justify why there should be at all any budget allotment for his decision unit. This justification is to be made afresh without making reference to previous level of spending in his department. Activities are identified in decision packages. Decision packages are ranked in order of priority. Packages are evaluated by systematic analysis. Available resources are directed towards alternatives in order of priority to ensure optimum results. Deficit budget. Deficit budget is one in which government's expenses exceed in its income. In the present time, nearly all the governments present a deficit budget. In India, prior to 1997, the deficit was made by printing more currency, but now this policy has been changed. The government now meets the deficit by taking loan from RBI. Balanced budget. A balanced budget, particularly that of a government, referred to a budget in which revenues are equal to expenditures, thus neither a budget deficit nor a budget surplus exists the accounts balance. More generally, it refers to a budget that has no budget deficit but could possibly have a budget surplus. Gender budget. Gender budget refers to the process of conceiving, planning, approving, executing, monitoring, analyzing, and auditing budgets in a gender sensitive way. It improves analysis of actual expenditure and revenue, usually of governments, on women and girls as compared to expenditures on men and boys. Single budget. The single budget is used by all the departments, program of government, all of the government's income and expenditure are included in single budgeting. Federal budget of America and Britain are the examples of single budgeting system. Multi-budget. It refers to the use of defined budgets in different departments and programs of government. Many countries like France, Switzerland, Germany, etc. use multi-budgeting system. Item-based budget. Demand of fund without showing its expenditure department-wise comes under them. Items-based budgeting. Vote on account is example of item based budgeting. Vote on account deals only with the expenditure side of the government's budget. Supplementary budget. The need of reconsider the already passed budget is certain due to unexpected reasons like natural calamity, decline in revenue, or some other emerging circumstances, and supplementary budget is formed to fulfill new demands and activities or to increase existing services. Performance budget. Performance budget present the main projects, programs, and activities in the light of the specific objectives and as an assessment of the previous year budgets and achievements. It provides a link between financial allocations and fiscal achievements by the concerned spending agency. Performance budget explain the scope and objectives of the schemes, their estimated cost, physical targets, achievements, reasons for shortfall, if any, standards of performance, etc. It also serves as an instrument of administrative and financial control in the implementation of various development programs. This budget was first introduced in America on the recommendation of Hoover Commission. Balanced budget multiplier. A balanced budget multiplier was first formulated in the wake of Keynesian analysis. It exerts direct impact on income and employment in the economy. To its possible repercussion on the allocation effective, it maintained that any increase in the government expenditure, even though fully matched by taxation, leads to an equivalent increases in national income. When the government collects additional tax revenue and spends it, the aggregate demand in the economy increases by by a smaller amount. Consequently, when net increases in aggregate demand in the economy, which generates its own multiplier effect. Earlier, the balanced budget multiplier formulations put its value at unity, meaning that a change in national income would be exactly equal to change in the government budget, irrespective of the value of the or marginal propensity to consume. The net initial addition to the expenditure per rupee n of taxes is given by n 1 minus MPC, while the value of the multiplier is 1 minus MPC. Government expenditure multiplier delta y equal to 1 by 1 minus c, delta g equal to delta y by delta g equal to 1 by 1 minus c. Tax multiplier delta y equal to minus c, delta t by 1 minus c equal to 1, delta y by delta t equal to minus c by 1 minus c, where C equal to marginal propensity to consume, Y equal to income, tax equal to tax rate, T equal to tax, G equal to government expenditure. It would be noticed that the value of balanced budget multiplier need not always be unity. Its being is only a special case. Example, if the government expenditure is in the form of transfer payments so that the funds get shifted from one section of the people to the other, the net effect will depend upon the relative MPC of the two sections of the people. This conclusion, however, is subject to two qualifications. It is very likely that the MPC of the taxpayer will be lower than that of the money recipients. A part of the tax collection would be used up as government expenditure on the tax collection and disbursement, and therefore it is most likely that even in the case of transfer payments, there will be a positive budget multiplier. Budget in India. In the Constitution of India, the term budget is nowhere used. It is rather mentioned as annual finance statement under Article 112, comprising the revenue budget, capital budget, and also the estimates for the next fiscal year called budgeted estimates. The following fact related to Indian budget are worth maintaining. As per the British legacy, the Union budget of India used to be presented on the evening of last working day of the month of February to follow the British budget. During the NDA regime, then Finance Minister Yashwant Sinha was the first to present the budget on 28th February 2001 at 11 a.m. It is now presented on the 1st of February. The budget has to be passed by the Lok Sabha before uh, before it can come into effect on 1st April. The first such mini budget was presented by T.T. Krishnamachari on 13th November 1956 in form of fresh taxation proposals through finance bill demanded by the prevailing domestic and international economic situation. John Marty proposed the first budget of Republic of India in 1950 and also the creation of Planning Commission. Finance Minister Morarji Desai has given budget for the maximum number of times 10, followed by P. Chidambaram, who has given 9 budgets. C.D. Deshmukh was the first Indian governor of RBI to have presented the interim budget for the year 1951 to 52. Mrs. Indira Gandhi is the only woman to hold the post of the finance minister and to have presented the budget in her capacity as the Prime Minister of India in 1978. Planned expenditure was for the first time presented separately in the budget for 1959 to 60. Planned and non-planned expenditure were removed from budget since 2017. The separated railway budget, a 92 years old tradition, has been scrapped by the Modi government in 2017. The government has approved the merger of rail and general budget on 21st September 2016. With the scrapping of the rail budget, railway also not have to pay a special dividend to the government for getting gross budgetary support. Preparation of budget. The budget is prepared by the Budget Division of Department of Economic Affairs in the Ministry of Finance (MOF) after consulting with other ministers and the Planning Commission. The process majorly includes following steps which may be sequential or overlapping too. Budget timeline. The budget draft preparation and finalized on last working day of year. Budget table before Parliament. General discussion on budget proposal. House adjourns individual ministers' demands for grant studies by standing committee. Detailed discussion and voting on ministers' demand for grant. New financial year brings from 1st April. Stages in budget enactment. The budget goes through the following seven stages in the parliament. Presentation of the budget on the floor of the house before the Lok Sabha. General discussion on the budget, vote of account, scrutiny by departmentally related standing committees, voting on demands for grants, passing of appreciation bill, Article 114 of the Constitution of India, passing of Finance Bill under Rule 219 of the Lok Sabha. Fiscal policy and its implications. Fiscal policy refers to the policy of the government with regard to taxation, public expenditure, and public borrowings. Decisions to lower taxation or increase public expenditure in the interest of stimulating aggregate demand are referred to as loosening fiscal policy. On the other hand, the higher tax rates or reduction in the public expenditure will tighten fiscal policy. Features of fiscal policy. Fiscal policy means measures by which a government adjusts its level of spending in order to monitor and influence the nation's economy. Fiscal policy is based on the theories of British economist John Maynard Keynes. The Keynesian theory basically states that government can influence macroeconomic productivity levels by increasing or decreasing tax levels and public spending. This influence in turn curb inflation, increases employment, and maintains healthy value of money. Fiscal policy also fits into economic trends and influences monetary policy. When the government receives more than it spends, it has a surplus. If the government spends more than it receives, it has a deficit. Measures of deficit of government. Budget deficit. The amount by which a government spending exceeds its income over a particular period of time is known as budget deficit, also called deficit or deficit financing. Fiscal deficit. A more comprehensive indicator of the government's deficit is the fiscal deficit. This is the sum of revenue and capital expenditures less all revenue and capital receipts other than loans taken. This gives a more holistic view of the government's funding situation since gives the difference between all receipts and expenditure other than loans taken to meet such expenditures. Fiscal deficit. Revenue receipts, net tax revenue plus non-tax revenue plus capital receipts only if recoveries of loans and other receipts minus total expenditure planned and non-planned. There are two types of fiscal deficit which are as follows. Gross fiscal deficit. The gross fiscal deficit GFD of government is the excess of its total expenditure, current and capital including loans, net of recovery over revenue receipts including external grants and non-debit capital receipts. Gross fiscal deficit equal to total expenditure minus revenue receipts plus non-debit creating capital receipts. Non-debit creating capital receipts are those receipts which are not borrowing and therefore do not give rise to debit. Examples are recovery of loans and the proceeds from the sale of public sector units PSUs. Net fiscal deficit. The net fiscal deficit NFD is the gross fiscal deficit GFD reduced by net lending by government. Fiscal imbalance and deficit financing. Fiscal imbalance is a situation in which there is a gap between revenue and expenditure. Deficit financing is a method of filling this gap, which is in India means borrowing from the RBI against the issue of treasury bills and running down of accumulated cash balances. This amounts to creation of money. The need for deficit financing arises when the government fails to mobilize enough resources to fund its plan. Since cutting down planned expenditure would hurt growth, the government instead resorts to deficit financing. Revenue deficit. It refers to an excess of government's revenues expenditure over the revenue receipts. It is expressed as revenue deficit equal to revenue expenditure minus revenue receipts. This variable includes only those transactions that affect the current income and expenditure of the government. A higher revenue deficit implies that the government is decisive or using of its saved resources due to scarcity of the receipts. It is an undesirable situation as the government is forced to borrow for its regular consumption process. This lead to additional burden of loans and liabilities on the government, which might force the government to cut its expenditure. Capital deficit. It refers to an imbalance in a nation's capital account in which payments made by the country for purchasing assets exceed payments received by the country for selling assets. This is generally not a desirable situation for a domestic economy. Capital deficit equal to capital receipts minus disbursement on capital account. Primary deficit. The borrowing requirement of the government includes interest obligations on accumulated debit. The primary deficit indicates the deficit amount that the government needs to borrow for consumption and investment purposes. Thus, primary deficit can be defined as primary deficit equal to gross fiscal deficit minus net interest liabilities. The net liabilities consist of interest payments minus interest received by the government on net domestic lending. Monetary deficit increment in net credit of RBI is monetary losses for the central government is referred to as monetary deficit. Monetary deficit equal to net growth of holding of treasury bill of RBI plus contribution of RBI in market borrowing of central government. Classification of fiscal deficit into structural and cyclical components. The balance of government budget is mostly affected by cyclical, temporary, and structural permanent components. It means fiscal deficit is influenced by either cyclical changes in production of creation of structural components. A cyclical deficit is a deficit that is related to the business or economic cycle. The cycle components is affected by government decisions. It is mainly influenced by national and international economic conditions, which can be significantly beyond government control. On the other hand, structural deficit occurs when a country or state, municipality, etc. post a deficit even when the economy is operating at its full potential. This is the opposite of the cyclical deficit, in which a cyclical deficit only occurs when an economy is not performing to its full potential. Therefore, a structural deficit means that a deficit will be posted regardless of how the economy is functioning, recession, boom, or and anything in between. Other important concepts or structural deficit. Fiscal burden. A deficit occurs when a country spends more than what it takes it. Fiscal burden is important contribution in structural deficit of central government. Balanced government in many countries run persistent annual fiscal. A budget deficit occurs when tax revenue are insufficient to fund government spending. It means that the state must borrow money, usually in the form of government bonds. Abundance in the budget deficit is fiscal burden of countries for next year. Fiscal consolidation. It refers to the policies undertaken by government to reduce their deficit and accumulation of devil stock. In India, fiscal consolidation is a process where government's fiscal health is getting improved and is indicated by reduced fiscal deficit. Excess fiscal deficit produced some adverse effects. In India, fiscal consolidation or the fiscal roadmap for the center is expressed in terms of the budgetary target to be realized in successive budgets. Fiscal consolidation and government states. Fiscal consolidation is important for fast, real, and self-financing economic growth. Strong balance of payment, low rate of inflation, etc. It are indications of economic stability. Increase in revenue, rationalization of public expenditure, size of public debt, increasing interest liabilities, decrease in fiscal deficit and revenue deficit, etc. are the step of government in the direction of fiscal consolidation.